The Minority Market. Episode 31. How Context and Multiple Time Frames Affect Decisions. Most traders look at only one chart and believe they understand the market. They zoom into a single time frame, see a pattern, and take a trade without asking a deeper question. What is the bigger picture saying? This is one of the main reasons traders get trapped. The market does not move in isolation. Every price movement exists inside a broader context. Context means understanding where the current price stands in the overall market structure. It includes trend direction, major support and resistance zones, market phase, volatility conditions, and participant behavior. Without context, even the best technical setup becomes dangerous. Imagine trying to drive by looking only at the road directly in front of your car without checking the highway map. You may move forward, but you will often take wrong turns. Trading without context is the same mistake. Multiple time frame analysis helps you see the market from different perspectives. Higher time frames show the main direction and structure. Lower time frames show entry opportunities and fine details. The minority always starts from the bigger picture and moves down to smaller frames. The higher time frame represents institutional activity and long-term participants. These players control large capital and shape the dominant trend. When you trade against this flow, you are fighting stronger forces. The minority aligns with a higher time frame direction whenever possible. For example, if the weekly and daily charts show a strong uptrend, short-term pullbacks on lower time frames are often buying opportunities, not selling signals. Beginners often make the mistake of shorting small bearish patterns inside a larger bullish trend. This creates repeated losses and confusion. Lower time frames are useful for timing entries and managing risk. They allow tighter stop losses and better reward-to-risk ratios. But they should not override the higher time frame structure. The minority uses lower time frames as tools, not decision makers. Another important aspect of context is market phase. Markets move through accumulation, expansion, distribution, and contraction phases. The strategy that works during expansion may fail during consolidation. Recognizing the phase helps you avoid forcing trades in unfavorable conditions. Volatility is also part of context. During high volatility periods, price moves faster and wider. Stops must be adjusted and position sizes reduced. During low volatility, patience becomes more important. Beginners often use the same strategy and risk size in all conditions. The minority adapts based on context. News and events also interact with technical context. A breakout before a major economic announcement carries different risk than a breakout during calm conditions. The minority does not ignore fundamentals completely, but understands how they affect short-term behavior. Another common mistake is zooming too much into small time frames. When traders focus only on 5-minute or 1-minute charts, they become emotionally reactive. Every small candle feels important. This leads to overtrading and stress. The minority balances detail with perspective. Here is a simple routine you can practice. Before taking any trade, check 3 time frames. 1 higher, 1 trading time frame, and 1 lower. Ask these questions. What is the main trend? Where is price relative to key levels? Is this trade aligned with or against the bigger structure? This habit builds contextual awareness. Multiple time frame alignment increases probability. When trend direction, structure, and entry signals align across frames, the trade quality improves. It does not guarantee success, but it improves consistency. Another benefit of context is emotional stability. When you understand the bigger picture, small pullbacks do not scare you. You stop reacting emotionally to minor fluctuations. This mental calmness is a major advantage. Context also helps with exits. Traders often exit too early because they see small reversals on lower time frames. When higher time frame trend remains intact, the minority allows trades to breathe. This leads to better profit potential. However, context does not mean overcomplicating charts. Adding too many indicators and time frames creates confusion. The goal is clarity, not complexity. The minority keeps charts simple and focuses on structure, price behavior, and key levels. Remember, the market is not random noise when viewed in isolation. It becomes meaningful when you understand its layers. Multiple time frames reveal these layers. As you continue this journey, train your eyes to zoom out before zooming in. Build the habit of asking bigger questions before making smaller decisions. This is how the minority trades with awareness instead of impulse. They do not chase candles. They follow structure. They do not react emotionally. They respond intelligently. This is the power of context.